Headlines regarding US and Iran peace negotiations become, confusing on Iran's new ambition to control the Strait of Hormuz for good, with Oman once the peace deal is inked. So oil is up again, yields are pushing higher, and this time around, even the technology's big names appear to be annoyed. So it's in this confusing macroeconomic and geopolitical context that the US is preparing to reveal its latest growth and inflation updates today. So welcome to Swissquote's Daily Market Talk. It's Thursday, 28th of May. I'm İpek Özkardeşkaya. We will talk about geopolitics, macroeconomics, and technology. But before we do, and as always, please keep in mind that opinions are my own, and this is not financial advice.
This show is brought to you by Swissquote.
A new issue, an unknown, a surprise, an unexpected factor in US-Iran peace negotiations has just emerged. Iran now wants to control the Strait of Hormuz with Oman. I hear it as the two are now willing to control and charge the ships passing through the Strait of Hormuz once the Middle East tensions are over. Well, I just realized how important the Watergate was for the entire world economy. Hadn't the US gone in, they would have never known it. So yesterday, investors swung between hope amid an Iranian memorandum, including that the strait would be open within a month after a deal is reached, and were slashed again after the US denied these reports, with US President Donald Trump saying that no nation would control the strait. The news somehow cast a shadow on how close the two parties really are to reaching a concrete deal with this new and emerging ambition of Iran. So in summary, a US-Iran peace deal and the reopening of the Strait of Hormuz now look more complex than they did just a few days ago. And the immediate impact in the market is higher oil prices. US and Brent crude are up this morning around 3% at the time I'm talking here, and the US 10-year yield rebounds past the 4.5% mark. So it's in this uncertain context that the US will release its latest growth and inflation updates later today. In terms of growth, the US economy is expected to have grown around 2% in the first quarter of this year, with price pressures stubbornly above the 3% mark, which is way higher than the Fed's 2% policy target. And the core PCE for the first quarter is expected to have bounced from 2.7 to 4.30%, reflecting the Iran-led price increases. On a monthly basis, the core PCE, the Fed's favorite gauge of inflation, is expected to have advanced from 3.2 to 3.3% year over year in April, as the initial impact of higher energy prices that echoed through the prices of other goods was already visible in last month's reading. The reasoning is always the same. A higher than expected inflation print today will further boost hawkish Fed expectations and fuel the probability of a rate hike in the US by the end of this year. And activity on Fed funds futures already assesses a nearly 60% chance for a December rate hike in the US versus the expectation of 2 to 3 rate cuts prior to the Iranian war. Then a figure in line with expectations, or ideally softer than expected, could ease the rate hike bets for the Fed this year, but won't take the idea of tighter monetary policy off the table as long as the geopolitical uncertainties loom and energy prices remain persistently high with risk of further rise. And yes, even with Kevin Walsh, who wish he could deliver his first rate hike this year, well, the rates might have to stay where they are or maybe even go higher. Then it's the good old domino reasoning for the financial markets. Higher rates push yields higher. Higher borrowing costs should limit borrowing. By doing so, they should also limit growth and hiring. And lower growth and lower hiring could tame a part of inflationary pressures, but not all, because inflation today is not caused by excess demand, but limited supply. In fine, it's up to the White House and not the global central banks to ease inflation. Scared? And there is more. Remember, before the Iran war started, there were two major worries among investors for the technology space. It is actually carrying the equity prices and equity indices higher. Those were massive AI spending, increasingly financed by debt from big technology companies, delayed ROI, and circular deals, remember. Then two, the software meltdown, remember, threatened by AI replacement, resulting in private credit stress and bank stress. The first set of worries, so the massive AI spending, increasing the finance by debt, and the circular deals, and the delayed ROI, return on these investments, well, is almost fully forgotten. The AI demand remains so strong indeed that investors join companies in worrying about not being able to catch up the rising demand than investing too much on that with prospects of structurally higher yields. But the second set of worries that was somehow easing these days just got a fresh boost on news that a Swiss-based pension fund just wanted to redeem all of its shares in Vista Credit Strategic Lending in the first quarter of this year. And that sounded bad because retail investors willing to get their money back is one thing, and institutions seeking to get redemption is another level of stress. But the good news is that the software company valuations have improved since April, making yesterday's news sound a little bit less dramatic, because today's software stress is more about not being able to fund businesses rather than immediate business failures due to AI replacement. But the latest news is a warning still that the private credit stress now goes beyond just retail investors' exposure and their level of stress. Alas, who cares? Micron, the new king of technology headlines, rose another 3.63% yesterday, pushing its total gains past 1,360% level since last April. VanEck Semiconductor ETF, on the other hand, advanced to a fresh all-time high level yesterday before finishing the session 1% lower though, while SoftBank was down by more than 5% this morning in Japan, and the Korean Kospi Index, which is basically the reflection of two memory chip makers, that is down by 2.76% at the time I'm talking here this morning. Maybe it's just a little blip. But looking at the extremely narrow market breadth right now in major technology hubs like the US, Korea, and Taiwan, for example, being the top three, well, there are now two possibilities from here. Either the Middle East tensions will ease and the market rally will extend to non-technology sectors, which could cool down demand in technology but prevent a sharp sell-off, or the Middle East hopes will fall off a cliff yet again. Oil prices, inflation expectations, and yields will continue to rise, also increasing the likelihood of a sharp market correction that would also concern the technology names. Now, opinions are mixed. Goldman Sachs analysts suggest that the S&P 500 could hit the 8,000 mark this year, while the European Central Bankers, another set of folks obviously, warn that asset prices look stretched and financial markets are in danger of correction. Elsewhere, investor surveys remain incredibly bullish, while Main Street surveys are weakening by the day. And truly, the weaker the Main Street sentiment, the better it feels in the financial markets, as weaker consumption and weaker economic activity only mean weaker interest rates, weaker yields that are mathematically positive for valuations, especially provided that earnings growth also remains robust and earnings expectations are very strong. Let's take a moment to remember that the S&P 500 companies printed an earnings growth of more than 28% in the first quarter of this year, despite the trade war, despite the Middle East war, despite all. So the best is probably to chase the dips and stay invested, because part of valuations reflects the stock price inflation due to ample liquidity injection that must find a place to go. And the good news is, if there is no place left on Earth to go, space is becoming the next shiny option. Look, Procure's Space ETF, for example, is literally targeting the moon today with a 363% rise in 2 years. Well, that's not as impressive as Micron, but clearly exciting for those who have the nerves to jump on board of this UFO, which happens to be the ticker of that ETF. On this note, let's keep an eye on the US growth and inflation numbers today. Hope for the best, but stay prepared for the worst. So this is all for today. I'm İpek Özkardeskaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.